Ever wonder how a few missed mortgage payments in an average American neighborhood can vaporize $700 billion in retirement savings in a single day? When titans like Lehman Brothers collapsed, it triggered a panic that erased trillions of dollars in value and brought the global economy to a standstill. Historically, lending was highly contained. If a single homeowner couldn't pay their mortgage, the local bank absorbed a minor, isolated loss, and the rest of the market moved on. So how did modern financial engineering rewire the system so tightly that these isolated local defaults mathematically guaranteed a global explosion? Today's global economy functions as a highly pressurized, completely interconnected engine, where a single spark in one sector can ignite the entire system. The spark began with a massive boom fueled by easy credit. Lenders aggressively handed out mortgages to nearly anyone who asked, regardless of their ability to pay. Wall Street wizards took thousands of these individual, high-risk home loans and bundled them together, mashing them into single, massive investment products. Through complex mathematical manipulation, they managed to get these dangerous bundles officially rated as super safe investments. Armed with these pristine ratings, they sold the bundles globally. Massive financial institutions all over the world bought them up as quickly as they could. By successfully masking the risk inside those bundles, Wall Street poured a foundation of hidden financial toxins beneath the entire global structure. To buy more of these highly profitable investments, the banks scaled up their purchasing power using a dangerous mathematical multiplier. Imagine you want a $400 smartphone. You only use $10 of your own cash, and you borrow the other $390 from 39 different friends. The catch is, you rely on overnight loans. You have to pay back those 39 friends tomorrow by borrowing cash from 39 new friends. Everything is fine as long as people keep lending you money every single day. Scale that up. Major Wall Street banks executed this daily cycle with trillions, borrowing up to $40 for every $1 they actually held. Global financial institutions relied on a daily, unbroken chain of short-term borrowing to maintain their basic operations. Then, the housing bubble bursts. Homeowners start missing payments and defaulting on their original loans in massive numbers. Because those original mortgages failed, the massive bundles that were built out of them lost their value almost immediately. Major institutions woke up to a terrifying reality. Their vaults were suddenly filled with billions of dollars in highly toxic, plummeting assets. Panic sets in. The short-term lenders providing those daily overnight loans hear the assets are broken. They refuse to roll over the debt and demand their cash back instantly. This ticker display shows cascading rows of stock prices plunging into the red. Forced to pay up immediately, the banks frantically sell their assets all at once, triggering a catastrophic fire sale that drives global prices down in a self-feeding spiral. Mathematical leverage works both ways. It multiplies profits during a boom, but can wipe out a bank's capital base in hours when prices fall. The chain reaction breaks the financial ecosystem, leaving the public gripped by panic. A market crash represents a sudden and complete evaporation of institutional trust. Without trust, banks stop lending to one another. The credit that keeps the economy breathing freezes. Businesses can't get funding to operate, and the broader economy suffocates. Any financial system built on extreme, interconnected borrowing and disguised risks is inherently fragile. While money is the visible fuel of the global market, invisible trust is the absolute only structural pillar keeping the entire system from collapsing tomorrow.